Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so that means if you're collecting $2 on the call side and lose, that's all well and good, but if the put side is at the maximum loss and you're losing $8 on the put side, or rather $18 in this case, because this is a 20-point spread on either side, a $2 gain versus an $18 loss on the put side, that's a lose, right? You're still down 16 points. So don't be under the misconception that because you can't lose on both sides at the same time that you can't lose, and that is definitely not correct. Okay, so let's get into a little more specifically about what you're trying to do. What are the optimal conditions? Well, as I mentioned, you want the underlying to be range bound. Okay. Well, what are the things that you need to have in place, or what is the environment that is most likely to happen? Well, that would be something lacking in news, right? If you're trading a stock, if you're trading stock options, equity options, okay, companies commonly report earnings 4 times a year. And that usually has an increased activity level or propensity for fluctuation in the stock price around those times. So that probably is not a good time to place an iron condor trade. Okay? You're looking for things to be quiet. So you're not going to place it during a time when it's expected for volatility in the underlying price to have increased. Well, what if you're trading an index option? Well, if you're trading an index option, now you're more concerned about major market events or major market news that is set to come out. So now you're in the pool of economic indicators, Fed meetings, and that sort. But just because something is a big news event at some time doesn't mean that it's a big news event all the time. You know, you need to look at the relevancy to what's happening today. You know, if the Fed is having a meeting on Tuesday or Wednesday, unless they do something completely unexpected, it's probably not going to move the market that much right now because interest rates are so low already. However, you know, you have some economic data such as unemployment where everyone is focused on jobs, 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 and you get something that's really off there, yeah, that's probably going to move the major market indices a lot more than a Fed meeting at this point. Now, that doesn't mean it's always going to be that way, but you just need to look at the major market news events in relation to what's happening today. So if you're looking at placing a condor because all the other items are in line and you have some huge economic news everyone's waiting on, or some other big event such as like a presidential election, maybe it's best to hold off and wait until things settle down and you can reevaluate, okay? Because you're always trying to go for the best possible odds when you place a trade that it's going to work out. And one of the ways that you can do that is just to be aware of the news events that may ill affect your trade. As I mentioned, we don't want to place this trade more than 60 days to expiration, usually because you're focusing on the time decay. And also, it's much harder to get an idea of what's going to happen 90 days from now, 120 days from now, and so on. And finally, the last piece of this here is implied volatility. You know, we're trading options, and implied volatility is a very important part of an options price. In trading the iron condor, you want option prices to all decrease. So that you want the prices to all decrease, and declining implied volatility is what goes along with that idea. So that usually happens when markets are quiet, right? There's nothing going on. Volatility tends to just creep lower and lower and lower, which is great for you because if nothing is going on, that means it's range bound, which is what you need for the underlying, and volatility is decreasing, which is what you need for the options. That sounds perfect to me, right? Well, the other side of that is decreasing implied volatility tends to also go hand in hand during an uptrend of the underlying, right? But this strategy does not work in an uptrending market, right? Because we need the underlying to be range bound. So just because you have one component, not necessarily going to be enough to say, hey, let's do the trade. Okay, so just be aware of all the different moving parts here. All right, so now that you know what the three main areas are, and there's only two of them that you can really do anything about, right? You can only try and forecast the price movement of the underlying, and you can only try and forecast the implied volatility. The passage of time, this involves the selection of the options that you use for the trade, right? So now we're talking about forecasting or attempting to forecast. Well, what are the tools that we have? Well, TradeKing offers free tools to help you come up, again, with the best possible odds of you making a successful trade. We provide a free probability calculator, which will give you the standard deviation. And what this does, it helps you to select the strikes that you're going to sell. Okay, because when you choose those strikes, the short strikes, that basically defines the range. I mean, not to the penny or anything, but just as a concept. If someone says to me, oh, I did this condor and I don't know what to do, it's not really working out, all I need to know are the short strikes and where the underlying is to know what type of situation this trader is in. Okay, because I know that you need the underlying to be within the short strikes, right? That's what we talked about early on in the presentation. I'll get into a little bit about what standard deviation is about. I'll show you a screenshot of the probability calculator. So if you're not clear on what standard deviation means, just sit tight. I will get to it. The other part that we talked about is, defining what you think the underlying is going to do. Now, in this case, I'm only mentioning technical analysis. You could use other methods. Fundamental analysis is one of them. However, that would not apply to an index, right? Because you're not talking about one particular company. But the reason I'm also mentioning technical analysis is because it lends itself to the shorter term. And we already said this trade is most likely not going to last more than 60 days. So what you're doing here is you're just saying, okay, what is the trend the underlying has been in, and what trend do I think it will be in once I put the trade on until expiration of my trade or until I get out of my trade, whichever comes first. So you're just trying to gauge what you think is going to happen. And, hey, as they say, a picture is worth 1,000 words. And then finally, we mentioned a forecast of implied volatility. Okay, and I refer to this as relative implied volatility analysis. Now, this is much more complicated than just a soundbite. But I have covered this tactic in a previous webinar with Steve Meisinger on FX options. And it's titled Improving Your Odds When Trading FX Options. It is in the on-demand recordings. I located it just to be sure. So if you're interested in that, I suggest that you check that out. I also have a similar topic covered on TradeKing.com, and that is to choose your strategy, and there are 3 different parts to that series. And as I mentioned, all these tools are available at TradeKing.com. We have a probability calculator. We have technical analysis software, as well as charting. And we also have volatility charts so that you can perform volatility analysis.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.